Hi, everyone. This is Jason Barrack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. We had him on earlier in the year. It's value investor Charles Ortel. He's the managing director of Newport Value Partners, which provides independent investment research to professional investors and high net worth clients. And he's also a columnist at the Washington Times. So thank you for joining us here today, Charles.
Thanks so much for having me on, guys.
Charles, I want to start off this podcast discussing geopolitics. Look at what's going on around the world. We have a conflict between Ukraine and Russia, and that's affecting the U.S. economy as well, because there's concern that Russia may go outside the dollar system and settle trade using alternative currencies. I just read an article today that Turkey and Russia are going to start using their local currency to make trade and etc. So what do you think of that, and do you think investors should be concerned with that, and what do you think it's going to be the impact on the dollar?
Well, thank you so much for asking that question. Well, that happens to be a topic I have been all over now for many months in advance. And our firm's thesis, we bring together people with deep experience, not simply in investing, but in geopolitics, in macroeconomics, in politics. And our thesis really is that, you know, when historians, maybe soon, but certainly in 10 years or so, when they look back on the period 1991 forward, they are going to look at, you know, all the presidents, all the leaders in both parties in the United States, all the chairmen of our Federal Reserve System, and they're going to say, boy, oh boy, did everybody miss the boat. And the boat that they missed to set up this whole geopolitical situation is that prior to 1991, literally billions of potential workers, human capital, were locked down under regimes that couldn't truly compete effectively in the global business market. Secondly, the power of machines back in 1991 was so much less than it is today that even back then we didn't have the opportunity as business owners to think about replacing each of us with, you know, a portion of a machine's capacity. All that changed, and it really changed. Tough to pinpoint the date precisely, but it changed around, I would argue, somewhere in 2001-2, when broadband internet became accessible in so many places in the advanced part of the world. So on the one hand, you have, you know, a major dislocation in the labor market now, with huge excess supply of laborers pushing things down. On the other hand, you have the strange phenomenon that in the part of the world that is nominally the richest, that is to say Japan, Western Europe, North America, these governments in these places are wedded to a value-destructing business model, wherein, because there is no other alternative than these major fiat currencies, and because there's so much wealth in the world, governments in these places have to date been able to sell their paper way at prices that make no sense whatsoever. And they have become sloppy, and they have become basically arrogant, and, you know, they don't appreciate that there is one unifying risk to the global system, and that is for how much longer, and I think, Jason, you mentioned this in the intro, for how much longer will the Federal Reserve, the European Central Bank, the Japanese Central Bank, the English Central Bank, et cetera, for how much longer will they be able to sell fiat currencies in the way that they've been selling them? And I think the handwriting is on the wall now. Russia, if people take anything away from this interview at all, what they should need to do is go back to the January 27th, 2009 speech that Vladimir Putin gave at Davos, opening up the World Economic Forum. In it, he very correctly looked at the West and the problems in the West and the addiction that the West has with the too much debt that comes our way because at present there is no alternative. He advised against crony capitalism. He advised against, which is a bit rich coming from him, I'll admit that. But he also he advised against the state getting too involved in all these economies, and we did not listen to him. Last year, for The Street, I'll shamelessly plug myself, but on June 25th, 2013, I authored an article called Prepare for a New Banking Regime, in which, it was picked up by Yahoo Finance, in which I suggested that the situation is ripe for, just as happens in reinsurance, as happens in many different places, for a group of the sovereign wealth funds who were so badly bruised in the 2007 through 9 period, when the big governments rushed them in unwisely into rescue maneuvers. The sovereign wealth funds, the rising nations like Russia, which actually is cash rich, to a certain extent India, to a certain extent China, to a certain extent Brazil, to a certain extent South Africa. You mentioned Turkey. I'm not so sure about Turkey. But definitely the sovereign wealth funds like Norway and Canada and throughout the Middle East. How easy would it be for them to get together, set up a new financial institution capitalized with not $100 billion, as was discussed last week in that arrangement, but say $250 billion? And then it's outlined in the article what to do next. So in the geopolitical sphere, what we have is, strangely, the West seems rooted for a variety of reasons, given the strength of our public sector unions, given our laziness, really, throughout the entire Western world, given the fact that we've grown up rich. We haven't known the kind of economic privation that happened throughout the Soviet Union. We seriously believe that we can run these gigantic deficits year in and year out. And I wrote, again, I'm sorry to promote myself, but in my Washington Times articles, right as the Olympics were ending this year, I suggested that Vladimir Putin, he's not acting foolishly. What he looks at this situation and he says, these nations that are on the periphery between the Soviet Union, former Soviet Union, and Western Europe, they are being pushed into economic suicide. Whereas if they were to drift back over towards Russia, there might be a lot more opportunity for many of these nations in a strengthened Russia that would have its own ruble that could depreciate. And they've talked about creating this new currency in union with some of the other former members. So what's going on in the geopolitical sphere here is not like a tit-for-tat spat. It's not a judo match. It's not something that happens and we should just say, oh, this happens every year. This is historic. This is, ironically, a bunch of people who grew up communist who are behaving as if they actually scored perfect scores on economics exams, whereas our own politicians scattered, certainly in the United States under this administration, but throughout the Western world, with the exception of Canada, these politicians are behaving as if economics doesn't matter, and it does.
Well, I mean, Dick Cheney said that debt doesn't matter. Didn't he say that when George W. Bush was there? And that seems to be the paradigm that Republican or Democrats, that the politicians in power seem to have, that, as long as interest rates are this cheap and we can continually borrow thanks to the Fed or whoever else is helping to suppress the interest rates this cheaply, it doesn't matter of what the total principal of the debt is, as long as we can continue to easily make the interest payments, which then, puts us into a Japan or worse situation down the line, right?
Well, I think Ernest Hemingway said it best in, I think it was Old Man in the Sea, and I believe that Zuckerman referred to it in an article earlier. In The Old Man in the Sea, the old man was asked, how do we go bankrupt? Or how do you go bankrupt? And the answer is slowly, then suddenly. And in the case of what Cheney was saying, the best way to look at that is to go into the Federal Reserve website. They have something called the Z-1 historical statistics that go all the way back to 1945. There may be problems with them. There are estimates. Nothing's perfect. But you can get a quarterly look in recent periods and an annual look on a consistent basis at the total amount of debt on the American economy. And he was right, perhaps in, let's say, 2001. But he certainly wasn't right by 2005 when the financial institutions went haywire, borrowing on top of borrowing on top of borrowing. And he's definitely not right today. And, then you go in the same website.
There has to be a limit, right? I mean, trees don't, it's like what Jim Rogers has said in his interviews, trees don't, sorry to interrupt you, trees don't grow all the way to the sky, right? There has to be, this is unsustainable. It can't go in terms of, it can't be exponential for forever, right?
Well, and yeah, strangely, back in, I don't know if it was like this for you guys when you went to college, but when I went to college, I just, back in a different millennium, I decided I would study something for fun that would let me travel. So I studied Africa and Middle East economics and politics, particularly developing country economics. And I never thought I would actually use that work to think through what's going on in the United States. But what's going on, if we did not have the ability to do what the Federal Reserve has been doing since January 1st, 2009, when they abruptly started pushing interest rates way down, below all reason, piling on debt after debt. If we didn't have that ability, I wrote an article saying we'd be Greece. We'd actually be worse than Greece. We'd be probably Kenya without the game parks.
Well, maybe if the Federal Reserve did not push interest rate to zero, and we didn't bail out all the banks and GM and any other automobile companies, maybe we would have a different outcome. Maybe the economy would have recovered by now, because then we have deflation instead of all this inflation that we have in the system right now. Do you agree or disagree?
I totally agree. I mean, I have a background in business restructuring companies. Some I wanted to, some I didn't think I'd have to restructure. And, basically what you ask yourself with these companies that get into trouble, like the United States is now in trouble, does the business model make sense? Is it a good business model with a bad capital structure? Or is it a bad business model with a bad capital structure? And if it's a bad business model with a bad capital structure and you don't change the business model, you certainly are going to go bankrupt, which, by the way, is what's going to happen to General Motors again.
Well, let's discuss General Motors and why they're having a bad year in 2014 with all the recalls that they had on various models, Chevrolet, the Saturn, and I can't name them all. But it's been an awful year for GM. Not surprising, mainly because GM not known for the quality cars and also controlled by the government.
Well, it's not actually so much controlled by the government now, but let's talk about that, because that happens to be one. Again, if you Google me and GM, you'll see quite a lot written and quite a lot of interviews on that one. In the case of General Motors, if you go through the publicly available data, what you will discover is something that is enormously curious, and that is that the way they accomplished the bankruptcy was to sell, the bits and pieces of General Motors that they thought were salvageable to this new company. So, Joe Biden is fond of saying that new GM never actually went bankrupt. And he's technically correct, but the way in which, he's technically correct. He's always half right, but a 50 doesn't amount to much. I didn't say it. But that could be an insult to weasels. But anyway, but the issue with General Motors is, they talk with Steve Ratner's book, they talk about these projections that were used to induce the unions to make their concessions, the governments to make their investments, and yet these long-term projections, which supposedly would have made it seem as if it made sense to make the concession and take equity and made it take the warrants and all that, these projections have never seen the light of day. I've tried to find them, and maybe I'm just not good at teasing out public data, but I think I'm pretty good at it. I haven't been able to find them. A number of years ago, actually, in 2012, I started thinking about this, and I said, let's think about the business model for General Motors. What is it actually? They don't sell to customers directly, right? They sell to dealers for their cars and their leasing business. Right? and they channel stuff. So they don't have visibility into their end-use customers, right? Their end-use customers, very few. I mean, there are statistics or estimates out there. There's some pretty good data. Very few people around the world go to their local dealer and write a check, right? So what you discover when you look hard in the car business, the vehicle business, and you look hard at who the customers are of General Motors, and General Motors in particular, it's the subprime segment. And they have been able to buy these cars from these dealers because the Fed has kept interest rates really, really low. If interest rates, or I should say when they return, even close to, not to the actual historical mean, but close to it, this is a business that will get slaughtered everywhere. It'll get in the United States. It'll get slaughtered in Europe. It'll get slaughtered now in China. This is now, I'm talking vehicle sales to dealers to customers. The leasing side, same thing. And if you posit that what we're actually going through here, going back to geopolitical stuff, we're going through a redrawing of the map in the Middle East, where there could be a push by IS, this worse than Al-Qaeda group, to maybe destabilize Saudi Arabia. You could see oil prices go way up. You could see nominal rates go way up. You could see demand go way down. And if you were looking for a business, like a perfect storm short, right? General Motors, in my mind, is fantastic. Before you consider the next level of nuance, which is, it sure seemed kind of odd to me that the government exited in the main from all these securities, and then, wow, after they exited, after they got the money out, and by the way, exited at a loss, a financial loss, without considering, what is the target rate of return they should have gotten on the investment for the risks they took. When they exit at a loss, magically all these legal problems come to light. Well, if you guys remember the Facebook IPO, I wrote. I happened to be in India, but I wrote an article that came out moments before it was priced. And at the time, there was incredible brouhaha about the venture capitalists selling out when the retail was coming in. Please explain to me why the General Motors process, especially after the campaign in 2012, said GM is alive, Al Qaeda is dead. Please explain to me why that wasn't a pump and dump.
Because people trust the government, people want to believe. Americans more, I would say, than more realistic people in other countries want to believe that their government is still good, that their government is not capable of this much corruption or, screwing this many people over and stuff like that. But, you touched on this a lot with GM, is initially during the bankruptcy of the original company, the bondholders were screwed, the pension funds were screwed, teachers' unions who were holding GM bonds, right, who had held them for a long time in Indiana and, Midwestern states and stuff like that, they got screwed, right? And, when you look at the underlying fundamentals of GM, yes, they were selling a lot of cars. They moved factories to China, things like that, which somewhat, maybe you can make somewhat of a bullish case that they did dump a lot of cars. But then when you looked underneath that, you saw the channel stuffing, and then you saw the FICO scores of the customers. And a lot of these loans, like you said, are essentially subprime teaser rates. So they're meant to where a lot of them are no money down, or they're 96-month car loans where you don't have to make a payment for a long time. And the car companies like CarMax and these other guys are already planning, reacquisition things where and you're seeing car title loan companies pop up too. So these are all red flags that a lot of the car loans that have been given out since 2008 are bogus.
Well, and then in addition, if you want to get into the weeds a little bit, the Bureau of Labor Statistics actually has on its website information concerning employment levels by state in this industry. And when you look at that, for all of this, I don't think the United States or any country should be in the business of promoting venture capital inside its borders. I think that's a very dangerous thing. That's what Vladimir Putin more or less said in his speech. Because, once you start doing that, picking winners and losers inside a political system, you could control. The potential for corruption is just so huge. But when you look at, what happened to employment levels after all this inside the United States, you discover they're not that high. In fact, they're under peak levels prior to bankruptcy. That's one thing. The second thing is concerning General Motors alone. Its competition inside the United States consists of American subsidiaries of folks like Toyota and Volkswagen, who don't set their factories up in the states that are so screwed up in the United States, where in the main General Motors has its operations. If we, going back to this case of geopolitical turmoil and the dollar getting under attack, and my investing in underdeveloped country experience, what you need to reassure foreign investors that they will get a fair deal when they come in and when they go out, particularly in the automotive industry where the life cycle is so long. So these moves, screwing the creditors as they did in June of 2009, in violation of precedent, arguably in violation of law, not providing full and fair disclosure in a gigantic company, not in the end actually helping the unions all that much. Because if things go the wrong way, what you're going to discover, as the union people are going to discover, is they made these concessions to get securities that could be worthless. And they're going to be out of a job. So, you have that. And then finally, the General Motors disclosures, which I think they're going to make new ones on Thursday, they refuse to provide American-only financial statements, i.e., what are the costs, true costs inside America, what are the true sales to American customers only, not including Canada, not including Mexico, not including producing cars in Canada and Mexico. Show the American taxpayer what this deal has done for them. And I think you're going to discover that, it is an F And it's an F now. Imagine what happens when it becomes a Chapter 22, i.e. Chapter 11 for the second time.
Yeah, and they also stopped disclosing, according to Porter Stansberry. Porter, I'm not sure if you're familiar with Porter's work, but Porter tracks GM closely. Maybe you should talk with Porter if you haven't already about GM. He knows a lot about it, too. I think he was talking about it at the latest Stansberry conference. I don't go to the conferences, but I do listen to Stansberry Radio. I think it's a very valuable resource. But anyway, though, they stopped disclosing the FICO scores. So I guess the FICO scores, the trend was just, lower and lower quality of person who was getting car loans, and GM didn't want to show this trend because the stock price was going up. They were dumping cars faster and faster to the distributor, and it looked good. And people on Seeking Alpha were saying, "Hey, wait a second, sales are up, and car sales are up, and GM looks good, and the stock chart looks good." And they wouldn't even dig deep enough to look underneath what was really happening. Most of them don't even care.
Exactly right. I mean, unfortunately, on GM, on GE, on a lot of the big cap names, they're paying, fancy dividends that are, higher than the current risk-free rate on 10-year bonds. That is the yield on those bonds. And people say, look, I'm getting nothing in my money market fund. Here's a good way to get some yield. If they own GM, if they're in GM at a low cost, they say, well, I don't want to sell now and pay the taxes, which is, specious reasoning. But this is a time, it's odd. I mean, here I am, I was chairman of the Yale Conservative Party when I was 19, and I haven't gotten less conservative economically. And here I am pounding the table about how this is a very risky investment for widows and orphans when we have supposed progressives in power in the executive branch. And, yes, they're going after GM for the switch problem. Let's see how hard they go after them for the way in which this transaction was constructed, the way in which it was disclosed, and the way in which the government may have duped widows and orphans into these securities.
It's very interesting. Now, let's shift gears here. You talked about the riskiness of some of these large cap stocks. You're a value investor, Charles. You help out hedge funds and high net worth clients with potential value investments, and you've restructured companies, which is, value investors can do that, buying distressed assets, distressed debts, and things like this. My question to you is, as a value investor, is it tougher to find margin of safety now in the general stock market?
Absolutely. I mean, in my experience, and I'm sure in your experience, what happens is that at any moment in time, there are always screaming bargains and screaming danger zones. But at no time in recent history has there been less of a pool of screaming bargains in publicly traded securities and more of a gigantic quagmire, a reeking, odious swamp in the public market, starting, frankly, with, the benchmark 10-year debt. When you have so low and you have the Fed intervening so much, it pushes the price. And Janet Yellen says she can't recognize a bubble, but, there's your biggest bubble.
It's rate-free risk, like Jim Grant of Grant's Interest Rate Observer says. And I mean, I'm not a big fan of the capital asset pricing model, some of these other academic theories, like efficient market hypothesis and modern portfolio theory anyway.
Well, actually, I've devised sort of a back-of-the-envelope way of thinking about it based on experience and a mixture of the capital asset pricing model, which, of course, has so many theoretical flaws. And the simple way to think about it is this. If you go back to the period I loved, 1981 to 1989, let's say, in that period, real interest rates, in hindsight, real actual interest rates were staggeringly high. I mean, they were, in some years they were like 7 and 8% real in U.S. dollars. And in that environment, some companies thrived. They showed gigantic intrinsic per household sales increases, expanding gross margins, expanding cash flow margins. They weren't that indebted.
They had to be efficient, right? They had to cut all the fat because of the high debt, right? They didn't have any of this cheap capital where the guys can do now with the scam, right, where they can buy back their shares and not have to invest it in growth or research and development and things like that, right? They could just play this game where they use the cheap debt to buy back shares to beat earnings estimates, right, by a penny, and then their stock options kick in. That seems to be the name of the game now, right?
Well, that could be the game now, but back then, and it's worth spending a bit of time on. So I mentioned we focus on geopolitics first, then politics, then macroeconomics. This is macroeconomics. If you look at the structure of the population in the United States between 1981 and 1999, something very interesting was going on, and that is that just because of the pattern in history, the number of people aged 25 to 54, and these are the people who just throughout history and all over the world, going way back, these are the people who are the most economically active, i.e. they consume the most, they form households, they build homes, they remodel them, they spend money on their children. They're not cutting back as they get older. This group burst onto the scene in America, and you can see this clearly in census data year by year. It just became a gigantic ever increasing number of people. At the same time, the number of older people actually was flat. So the ratio of older people to people aged 25 to 54 started plummeting, and the number of young people wasn't that great. So you had a very unusual, from a demographic standpoint, inside the United States, you had a very unusual set of circumstances. Outside the United States, you had Europe abandon socialism, America turn away from socialism, you had gigantic export markets open up, and you had a period that's just, I don't think is going to be repeated anytime soon. And ever since then, central bankers around the world, have just been, I think, conspiring is probably too strong a word, but let's just say colluding, and bringing the price of these fiat currencies, the interest rates of these fiat currencies down. There hasn't been, and I commend you to, there hasn't really been in the mainstream press the kind of incisive, critical investigation and analysis of what's going on in these companies. The political sphere, is captured. The regulatory sphere is captured. And, I fear that what we have here is a gigantic disaster. I think Grantham of GMO is warning that, and he's a very shrewd man, he is warning that the coming collapse will be the worst ever. And I tend to agree with him.
Now, looking at the whole economy, using your investment strategy, you look at geopolitics, demographic, macroeconomics, and then you look at the investment matrix. What do you think is the best asset class to invest in for the next 5 years?
Well, what I'm doing personally is, the people who have made the most money, and I think this is really the time to do it, is to find a private company that you can create that has global growth potential. That's where you asked me to rank where you're going to make the most amount of money. That's obvious. So you look at
invest in yourself. You mean?
Well, not simply yourself. But not just I got nothing wrong with setting up a lemonade stand. But if you want to make the most amount of money, you've got to think through something that will disrupt or take advantage of the disruption that's already in progress, and that will lead you to a place where you can have customers in numerous geographic markets, ideally customers in the top quintile, those in the United States who make about $150,000 per household and spend about $100,000 a year. That's your prime customer base. To operate in the bottom 80% around the world in a startup, I think is very dangerous. So, if you're going to shuck and jive in the private investing world, that's a good place to do it. Particularly if you have the ability to put a team together, the scars from having done it before, the common sense to think through in advance what the risks are and how you may mitigate them. That's where you're going to make the most amount of money. In the public sector, the way we look at it, there's some very quick screens to do on public company data. And virtually all public company data in the United States is horrible. I mean, it does it. You produce once per year consolidated financial statements that are audited. The audits, you could question how stress testy they are, and they don't require these 2014 companies to produce information that is consistent with the reality in 2014. A lot of these big companies, in my experience, particularly ones that started in the United States, they have gigantic actual and legacy liabilities inside a country that could well veer further to the left before it goes back to the right. And outside the United States, here we have, you can say that what we want about, I'm not particularly happy with George W. Bush, but you could certainly say, without getting too much into politics, that America's stature in the world is diminished, and that American companies, for many reasons, you saw what Putin did to Microsoft and IBM, that American companies are going to have a harder go of it outside our borders building international businesses. So if you split it into two and say, inside the U.S., how would you value the U.S. piece? And then outside the U.S., how might you value the international opportunity? When you do the kind of work that you guys can do and that we can do, you don't come back saying that General Motors is worth $36 a share.
Yeah, I would agree. Yeah.
And so in terms of, public company securities, what I like to look at are the following. I'd like to see revenue growth from I'd like to be able to look at a company and say, this is the same sort of business in, let's say, 2011 as it is today. So I'm dealing with the same sort of business. I like to be able to break it down to units and say, I'm getting, the units are increasing, the price per unit is increasing, the sales, therefore, show strong intrinsic growth with no monkey business. These aren't sales to people who are only buying the product because they get financing. This is, very strong intrinsic growth. You are not seeing signs of that virtually anywhere, even though we've had historic support for the economy, both in the fiscal side, in the reckless spending with borrowed money, and on the monetary side. So you're not seeing that. And then you get to gross profit margins. In the old days, in manufacturing, you could see very high gross profit margins, 40% even. Take a look at Boeing. Take a look at the industrial piece of General Electric. Take a look at Caterpillar, Deere. You pick it. The gross profit margins of these companies are under assault. And these are with accounting rules that may or may not be as tough as they should be. Then look at, I don't really care about EPS at all because it's so manipulated. What I'm interested in is free cash flow. And a simple way to get that is to look at cash flow from operations, that is, the companies report in their audited statements, and subtract from that capital expenditures. Forget all the financing changes. Then look at how much free cash flow how much free cash flow does the company generate per dollar of sales? And and also look at how much free cash flow does the company generate per employee. When you start looking at that, there are just not a lot of these large companies that look interesting at all.
So that's a very good point, Charles. And the free cash flow is definitely key. And, you're seeing companies hide the earnings, like you said, with the share buybacks. They're goosing the earnings higher because they're not really growing revenue. They're not growing the top line. You said that's important. I agree that's important. The margins are higher technically, right? The margins are higher, but mostly due to cost cutting since 2008, right? There's mostly due to cost cutting. It's not because the companies are coming out with higher margin value-added products or services in a lot of the large companies at least are not coming out with that. Maybe the small and medium-sized ones are. But, we're just not seeing the real economy, like you mentioned, here in the United States. We're not seeing a lot of real growth. We're seeing a lot of part-time jobs replace full-time jobs, and it seems to me like the only real growth in the United States is like from the shale oil boom, North Dakota or Texas, where they figured out with entrepreneurship and new technology how to get the oil out of the ground. There's new growth in Silicon Valley, with robotics and biotech and 3D printing and things like that. And then there's some factory jobs in small states and small cities. There are some factory jobs, but most of those factory jobs are very highly automated. So they're not, 5,000 workers at this factory. There's 500, and they're getting higher salaries, but most of the factory is, robots are highly automated, software processes, and things like that.
Well, there you've hit again another great topic for your listeners. I don't know how closely you guys get into this, but the Bureau of Economic Analysis, which is part of the Census Department, I think, produces tables, so-called NIPA tables, which you can get online for free. Now, they only update the employment information in August of each year, so we're waiting on those. But when you look at, and they have a lot of very interesting data, some going back to 1929. But then they change the way in which they think about the economy. So, the tables that deal with the recent period go from 1998 forward. when you look at full-time equivalent employees, you look at full-time, and then you look at their total compensation. So you can look at total compensation per full-time equivalent employee. Then when you use some kind of adjustment to bring it to constant money, either the consumer price index or whatever, some other approach, what you see is that real incomes are dropping. And actually in the tech area, surprisingly, now of course 98, 99, 2000, remember that was an unusual period in tech, but what you're seeing is that actual tech jobs are under today what they were in that period. And they're just, for the reasons we discussed at the very opening of the show, you've got cheaper human labor many places, but you have much more powerful machines today. And some of the visionaries looking ahead 10 and 15 and 30 years suggest that machines are only going to get a lot more powerful.
Yeah, I'm very bullish on robotics too. I mean, one of the things people don't realize is because of how cheap the inputs there for smartphones. So a lot of the apps and a lot of the hardware inside smartphones is really going to allow the price of robotics to fall a lot. So yeah, robots are gonna. People are. I know. There was a talk in mainstream media, 1965 magazine covers, right, about the robots are going to take away their jobs. Then it didn't. But look at the gains in computing power since really the 90s.
Well, absolutely. I mean, think about the trading environment. I mean, what percentage of prices today is set by machines?
Most
versus humans. Yeah, exactly.
Many.
Yeah.
Well, Charles, we appreciate your time for coming on. If people want to find out more about your work, where can they go?
Well, there's a couple places. I've become a more active Twitter user, so my handle there is @ Charles uppercase C, and then squished together uppercase OORTEL. There's a website, newportvalue.com. It's just we don't really like to provide too much information through that site, so it's skeletal. If you look me up on the Washington Times, there are quite a few articles, and now there's a weekly podcast show there that's getting some attention. Then finally, if you just simply Google me, Charles, and then Ortel, O-R-T-E-L, in quotes, and you then go, you could just look at the web portion. If you go to the video section, there's quite a few interviews there. And if you want to reach out to me, the best way to get me is on Twitter.
Okay, great. Well, Charles, thank you for your time, and hopefully you can come back on again soon.
Anytime, guys. The one thing I want to leave you with, as you didn't ask me about this because you're talking primarily securities, but the one screaming bargain in my mind right now is physical gold. And I say that because, the central banks are fighting it tooth and nail. The people I know who have the flexibility to own things for a long period of time are getting as much of it as they can. And in the inevitable correction, which I see coming, I don't know how much you guys check prices, actually, by physically going to stores and stuff. Prices are already starting to surge in this country. I think they're going to surge around the world. I think these central banks are going to get hit hard. I think there'll be a rush to some new form of reserve currency. And in that rush, there will be a new flirtation with gold. And, that's something that was trading as high as 1900 a number of months ago. It's now in the 1300 range. And, there's a place that it seems to me that, you don't have to be too fussy about it. If you've got a stomach and you want to, build a position for the long run, this is a good time to be shopping for physical gold.
And we agree with you. We've been advocating people to buy gold and silver for the past couple years for the reason that you just told us. Increasing global demand and the endless printing by the central banks all over the world and currency wars. Those are the top 3 reasons why people should buy physical gold and silver.
Absolutely.
Yeah, and I think the resource stocks are also, they're going to be leveraged to that physical gold and silver price that's going to go higher. Those guys have really cleaned up the fat on their balance sheets the last couple of years. They've been basically forced to because their cost of capital is so high, and they've had to cut costs and other things. So those are starting to look like there's actually some nets in there, Charles, which is very rare to see on the publicly traded stock market anymore with so many value investors.
Well, if I could just jump in, because you brought up one final point, which is that right now the biggest risk I see is counterparty risk involving the system writ large. So if you're an investor, with more than the so-called insurable amount, you face massive counterparty risk. So I wouldn't be buying, if you like physical gold for the reason I like it, you shouldn't be buying miners unless you don't have that much equity.
Okay.
But that much in the way of assets. Because I think come the crunch, we're going to see the same Cyprus-style arguments. We're going to see the mumblings coming out of Germany that, well, look, unfortunately, the rich are just going to have to pay for this. And, you thought you had $250 million in your various securities account. Actually, you have $500,000 and you should be happy.
Yeah, we call it the Keynesian Marxist asset grab. The politicians, want to redistribute the wealth and blame it. They did the mistakes, the politicians and the Keynesian central bankers and the bureaucrats. They don't want to accept responsibility for their mistakes. They want to dump it on other people, the responsibility.
Sounds bad to me.
Yeah. Well, Charles, thank you.
Thanks for having me on, guys.